All right. Good afternoon, Gadfly subscribers. It's Carlos. Happy Monday to everyone. Today is Monday, March the 30th. And today I am here with Ken Schortgen Jr. of Schortgen Economics, and we're going to do a market recap for you. So, Ken, go for it.
Hello, everybody. Let's see. Today is Monday, March 30th, 2020. And we're going to expound some more on gold. Take a look at the updates that the different dealers are charging for prices, see what the mint numbers are heading into last week. Then we've got I've got copies of a breakdown of what the new CARE bill that was signed last week, what it does for individuals and what it does for businesses. So we'll take a look at that. We'll jump into a few other interesting things, such as what the coronavirus is doing for Europe, especially Italy, as seeing Italy turning towards China versus turning towards Brussels, and bringing about the move towards the end of the EU. So let's go ahead and see what happened in the equity markets first. Well, as you can see, the Dow was up 690 points. Going into futures last night, it was down actually about as much as 350 points. But when markets opened today, after a tiny little sell-off, it was off to the races. Meanwhile, the S&P 500 was up 85 points, or 3.35%. And the NASDAQ was up 271 points, pushing closer to regaining the 8,000 handle. Bond markets, meanwhile, as soon as they refresh, they were selling off the front end of the curve. As you can see, the 3-month gained quite a bit of yield, but it's still negative when you take into account inflation. And on the back end of the curve, there was buying, so it still is a source of safe haven for foreign investors. Now, the Treasury market is available for foreign investors after the U.S. markets close. So that's why you see, if you go over and check some of the live charts, it will be moving in relation to what China does at the open, what Europe does overnight, etc. Meanwhile, the dollar did a reversal of what the last few days when it got down to the 97 handle. As you can see, it's up 71 cents today to 99.07. And there's not consensus on what the dollar is going to do. Some think it's going to go up to 105. Some people think it's going to break. For me, there's too much debt that is dollar denominated out there still. So as purchases of those dollars and the money velocity still banging around zero, I think we're going to see it probably get over that 100 point and more towards 105. That is a trend that's going. As a matter of fact, let's take a look at the 1-month trend here. And you can see the trend even going back to the start of the second week of March was pretty strong for the upside. That gaining about $7 on the dollar index. Meanwhile, gold continues what happened after the CME decided to close down. We are in a pretty much a trading pattern of about 1611 to at the most 1630. Not really much going on there because we are talking the paper markets. Wouldn't worry too much about that. But let's take a look at some of the gold dealers, some of the gold, some information that did come out in regards to the fact that the supply is at the rock bottom. These are the numbers for calendar year 2019. It should be 2020. There we go. From the U.S. Mint. And as you can see, they're 1-ounce coins. They are completely sold out. These are gold. Let me see if I can find the silver. Okay, U.S. Mint. It's not going to have the silver ones. These are pretty much tied to gold, but you can see that the supply from the mint, they don't have any to give the dealers. And because of this, we have no gold. The COMEX report exposes conditions behind the physical crunch. While the demand for gold has been soaring as a safe haven asset amid the multiple global crises we have been facing, forced paper gold liquidation, i.e. this, as leveraged funds scramble to cover margin calls, an unprecedented logistical disruption has been created in a frantic hunt for actual bars of gold. Specifically, as Bloomberg details, at the center of it all is a small band of traders who for years have cashed in what's always been a surefire bet, shorting gold futures in New York against being long physical gold in London. Usually they ride to trade out until the end of the contract every month, when they'd have a couple of options to get out without marking much, if any, loss. But the virus has changed all that. And to make good on maturing contracts, they'd have to move actual gold from various locations, which is being shuttered, or I should say scuttled, because there's so few individuals available to fly the gold back and forth to provide for the COMEX, thanks to the self-quarantines going on in the EU as well as in the United States. So this is why this is one of the most important things. The COMEX is tied to the spot market as well as the futures, and it is also the disconnect between the physical market. That's why we see this happening on the paper markets, sell off at 16.21 and 14.05, and take a look at what the prices are. This is my local coin shop, their updated website. As you can see, Silver Eagles, the price currently on the spot market is 14.05. But they're giving for U.S. Eagles $1 above spot to buy them from you, and $7 premium to sell. Now, this is actually on the low end, and I don't know how much inventory they've got. Each market will be different. Local coin shops will be dependent upon the local buyers and sellers, and depending upon your quarantine, you're not going to have a lot of people showing up there. But let's take a look at the online dealers. This is SD Bullion. This is how much a 2020 American Silver Eagle is selling for. If you're buying in below 1,500, you're paying in the $23. That's a $9 premium. Over at JM Bullion, you're paying an $8 premium. Over at APMEX, how about $29.73 for a Silver Eagle, one Silver Eagle? So you can see the physical market is fully disconnected from the spot market, and this is including at a time when miners are shutting down, depending upon what country they're in. They might get the national quarantine shutting down mines. The spot price being so low, they can't really afford to sell their to mine the metal, and the fact that silver, the majority of silver that is produced today comes from a byproduct of copper, zinc, nickel, etc., which in this recession is not needed for industrial use, so is not being mined to begin with. Now, one of the other interesting things that came up today, somebody out on Twitter, Russia's central bank will suspend gold purchases on domestic market from April 1st going forward. That means that the Russia central bank is not going to issue and allow the buying and selling of gold in its country. So Russia is now sequestering itself, same way that China does. China, you can buy all the gold you want, but it's like Hotel California. It will never leave. Moving over to Bitcoin. Bitcoin is relatively flat, still in a range between, it dropped down below 6,000 for a short amount of time over the weekend, but we're still in a range of between 6,000 and 7,000. Looking at the volume, we're just a little bit above average. Normally, average is a $500 million trading day. And the market cap is just the same it was when we had our last market recap, right at $120 billion for cryptos as a whole. But now let's take a look at the fun stuff. West Texas Intermediate crude for most of the day was below $20. A little bit of a buying at the very end brought it back over 20 to paint the tape. But we've now got oil below $20. Who would have imagined just 6 months ago? Meanwhile, this is one of the big things, geopolitical moves that was done going into Saturday as well. With Pompous Peo, Secretary of State, coming out and declaring the head of Venezuela, Nicolas Maduro, as a drug trafficker, we had the potential now for Panama 2.0. And when I say Panama 2.0, I'm talking about the U.S. invasion of Panama to get Noriega. So they tried to set this justification. So what happens? Rosneft, which is pretty much running Venezuela's oil industry, suddenly sells all its assets to a company controlled by the Kremlin itself. So instead of any potential disaster coming if the U.S. invades to the oil fields or the refineries in Venezuela, they are now going to be Russian national property, which means it's an act of war. So that's one way to shut down the U.S. invasion of Venezuela in a very quick moment. Meanwhile, well, the thing about having a repo market is you've got to have something to provide collateral to get your repo. That's no longer happening. As a matter of fact, the repo market has raised its limits to between 75 on the official side, but more like $750 billion per night. But nobody has any collateral anymore. There is a treasury shortage. And with JP Morgan and the other investment banks who were using that repo market, not really making any money now that everything has been shut down, we're going to see even greater deflation as one of the outlets, the windows for the banks to be able to get liquidity and cash suddenly shuts off. Now, here comes the fun part. We've got two strikes that are taking place. Amazon and Instacart workers plan strikes today, and they've already set in motion that. Amazon workers at New York Fulfillment Center are preparing to strike around lunchtime to call attention to the company's lack of safety protocols during the COVID-19 pandemic. The union represents workers in the Staten Island warehouse claims Amazon is more concerned about profits than the health of its employees. Well, we've all heard the rumors that you have to carry a bottle with you because they won't let you off the line to go to the bathroom if you don't make your quotas. And it's probably even more desperate for workers in Amazon because they are one of the few games in town that's actually considered vital enough to stay open. So how is this going to affect things going forward? Well, if more and more avenues for people to not be able to shop and get things closed down, you're going to see the unrest in the country start to really simmer and boil over. Imagine what happens if there's a epidemic that hits IT personnel and they can't support your local ISP and the internet goes down or intermittently goes down. Now, something else that's happening is that tomorrow, Whole Foods is going to go on strike. So that's one of the local grocery stores. And of course, who owns Whole Foods? Jeff Bezos and Amazon. Well, I want to go ahead and play this little thing before we get into the next segment, because this is the reaction people should have for the Federal Reserve and what they did in 2008 and what they're attempting to do today.
We did it. Yes. Yes, we did it. No price to pay. We broke our rules just like her. The bill comes due.
Yes, That's right. The bill comes due. The Fed's Faustian bargain. We're now experiencing endgame of the great debt supercycle. Echoing many of Jim Grant's recent fears, Guggenheim Investment CIO Scott Minerd fears the consequences of policymakers returning the same tools employed in the financial crisis as the grand Faustian bargain. Now, for those who don't remember, it's a drama from 1831. Faust, the devil, persuades a bankrupt emperor to print and spend vast quantities of paper money as a short-term fix for his country's fiscal problems. As a consequence, the empire ultimately unravels and descends into chaos. Today, governments that have relied upon quantitative easing instead of undertaking necessary structural reforms have arguably entered into the grandest Faustian bargain in financial history. With the global economy slipping into recession and many economists estimating second quarter gross domestic product growth in the U.S. falling by a minimum of at least 15% or more, the world is being confronted with the worst downturn since the 30s. Now, in the wake of that crisis, governments themselves have become highly indebted, requiring virtually continuous support from central banks to acquire the debt to maintain low interest rates to support growth. The average ratio of government debt to GDP for G7 country or economies has reached 117% in 2019, up from 81% just before the global financial crisis hit. Any attempt to taper or reverse the accumulation of government debt or other assets is quickly reversed as financial markets become unruly and the economy slow. Now faced with the exogenous shock of the COVID-19 pandemic, policymakers are returning to the same tools because they don't know any better, employed in the great financial crisis of a decade ago. They are desperately searching for programs that will fill the demand gap created by massive shutdowns, travel restrictions, while simultaneously finding ways to prop up businesses that to a large degree are overly indebted as a result of the low interest rates of the past decade. This is where the fun starts. Yes, they fixed the system in 2008. That's why Bernanke was granted the Great Savior on Time magazine. But now, that debt, which has fueled everything, the everything bubble, that debt now is the bill that must come due. Now, taking a look, we have the newest individuals who are demanding a Fed bailout, and that, of course, are the mortgage lenders. First, it was AG Mortgage Investment Trust, which on Friday said it failed to meet some margin calls and doesn't expect to be able to meet future margin calls with its current financing. Now, the whole thing behind this is that when a mortgage company, say like Quicken, or in this case, AG Mortgage Investment, any of these REITs, sell a mortgage or to a homeowner, they then seek to sell it to the government. The government doesn't always pay them face value. The government has a little bit stricter standards. So what these mortgage lenders will do is they will short mortgage-backed securities as a hedge for the loans that they do. But the problem is that these mortgage-backed securities are, as we showed from The Big Short last week, they're dog shit wrapped in cat shit. And so when they end up selling to the government, they are now getting margin calls to cover those hedges of the shorting they did with mortgage-backed securities. And thus, they are insolvent. So they are demanding a Fed bailout, and pretty much everybody's demanding a bailout. And if you think 117% of GDP is what the debt's going to be when we come out of this COVID-19 epidemic, you ain't seen nothing yet. We will probably, by summer, around the world, be at 150% debt to GDP. We have fully become Japanese. And no, I'm not going to play the song.
Speaking Japanese.
Now, what I want to do is I got a hold of a breakdown of what the new CARE Act that was signed into law as a bailout for individuals, for businesses, etc. And I'm going to go ahead and break that down for you to show you what your eligibility is. unemployment insurance provisions. Workers will receive an immediate benefit for an additional $600 per week for up to 4 months. This $600 amount applies even if the worker is currently making less than $600 per week. Additionally, 13 weeks of unemployment compensation may apply to the worker for participating states. Now, here's a little bit of a caveat. The Act provides federal funding for unemployment compensation to workers, which include gig economy workers, independent contractors, online platform workers. Sadly, that means YouTube workers. Let's see, on-call workers, temporary workers who are adversely affected by the COVID-19, who are not otherwise covered by state unemployment compensation. So, if you go for unemployment, you have to go to your state first, determine how much you're going to get, determine how long the state will provide for you, and then you will be able to apply for the federal unemployment, either to supplement what the state's giving you or to go ahead and give it to you outright. Rebates. This is cash. The rebate is an advance refund of credits against your 2020 taxes in an amount equal to $1,200 for individuals or $2,400 for the joint filers. Additionally, $500 credit for each child is also available. The amount of this rebate is subject to a phase out by $5 for every 100 in excess. We're not going to go worry about that. To whom does this benefit apply? The rebate is available to all U.S. taxpayers, even if the taxpayer has no income. It applies to individual filers, joint filers, and those who have filed as head of household. The rebate applies to those taxpayers. Anyway, you can see pretty much of your taxpayer. Note the rebates are exempt from offset to pay debts owed to other federal agencies, state income tax obligations, and unemployment compensation debts. However, the rebates are not exempt from past due support. Looking at retirement provisions. Several changes to retirement plans are included in the Act. Extension of the due date for IRA and plan contributions. Addition of provisions permitting a 1-year delay in required minimum contributions. I don't want to get into the minutia of this. I want to try to just stick with the general. The Act provides tax incentives to individuals who make charitable contributions above that. Let's see, treatment of student loans. Here's an important one for some. The Act provides for an exclusion of up to $5,250 from income for payments of an employee's education loans provided from an employer. Loan which is incurred by the employee for the education of the employee, yada, yada, yada. Let's go ahead. I think that's everything on that for the individual. Now, taking a look at business provisions, employee retention credits for employers subject to closure or experiencing economic hardships. So if you own a restaurant or a small business, it will give you credits, payments for keeping your workers going. Delay of payment of employer payroll taxes. So it defers the taxes. Provision will allow taxpayers to defer paying the employer portion of certain payroll taxes through the end of 2020. That would be the stuff on your W-2 primarily. With all 2020 deferred amounts due in 2 equal installments, one payment due on December 31st, the other on December 31st of 2022. So that's going to be for a year. You'll have to pay the deferment, but you'll have 2 years to go ahead and pay for that. Modifications, net operating losses. The Tax Cut and Job Act of 2017 limited net operating losses arising after 2017 to 80% of taxable income and eliminated the ability to carry these NOLs back to prior taxable years. In general, this provision would modify the treatment of NOL carrybacks. In the case of taxable years beginning before 2021, taxpayers will be eligible to carry back the past prior 5 years. So these are some things, that are important if you have a small business, and primarily what you want to do if you want to keep your employees. So let's minimize that. Now, this week we're going to have a special guest. We're going to have, say it's EJ.
Charles Hugh Smith.
Charles Hugh Smith of Two Minds. And this is something he wrote just yesterday. And it's significant and important because I want to go ahead and show a couple things in regards to it. What happens is state and local tax revenues crater. As we all know, the federal government can print money, but state, city, and county governments cannot. And that's one reason why they're also begging for money from the Treasury. Treasury can sell bonds to fund deficit spending, and the Federal Reserve can create the currency out of thin air, yada, yada, yada. State, county, and city governments do not have this printing press, but they can sell municipal bonds, which is something the Fed now will purchase. But the problem is that almost immediately the ratings agencies are downgrading the states. They're downgrading sovereign entities. They're not taking into consideration that this is a pandemic. So the cost of borrowing for states is going to go much, much higher. Now, in states like California that depend heavily on capital gains taxes, the holes being blown in budgets will be catastrophic. This is another reason why Trump is trying to get the stock markets pumped back up, because even more than what they get from individual income taxes, the government relies heavily on capital gains taxes, and that's why he's been pushing the stock markets and how great the stock markets are doing, because in reality, the whole system has been skewed that what you do in the stock market is much greater when it comes to being able to pay your bills at the federal government level than from getting income tax from you, me, and the person next door. Now, one of the more significant things that is going to happen here, of course, is that we are starting to see the slowdown, a more immense slowdown of real estate purchases, home buying, etc. That's going to affect states when it comes to their property taxes. And I found this interesting condo in downtown Phoenix that dropped the price $95,000 in just the last 2 weeks.
Wow.
This condo in downtown Phoenix used to be for about $675,000, and they've dropped the price down $95,000. Interesting enough, if you want to live in a complex like this, guess how much the monthly HOA is?
How much?
How about you're paying $1,177 a month just for the HOA?
Oh, dear Lord. Insane.
So, you know, the wealthy certainly live in a much different zip code than we do. One of the other things I wanted to take a look at is there is, as part of the CARES bill, and it wasn't mentioned in there, is that homeowners, you have between April, I think, about April 15th and July 15th, if you want forbearance on your mortgage payments, there is a program you can apply for it where you just simply, you don't need to document how the COVID-19 is affecting you. You simply just have to affirm, yes, the COVID-19 is affecting me. And you can get 120 days forbearance on your paying your mortgage. Now, why is that important? The thing to remember is you go through your mortgage lender and ask and make sure that your loan is a federally backed loan. Now, 98% of all mortgages are federally backed, so that's not a big deal for most people. But go ahead, and if you want, you can apply for the process, but do not, I suggest highly, do not stop paying your payments until you have gotten a written verification or an email or a fax that the forbearance is in play. Because even though the process may be going and it's pretty much assured, the credit agencies, just like the ratings agencies, could screw you for not paying, being 30 days in arrears and things like that. So you've got the chance for 120 days. Also, after that time, you can apply for forbearance again of another 120 days. What this usually means is that the interest will accrue on your home, but you won't have to make the payments for between 4 and 8 months. So for those who want to go ahead and halt, pay zero on your mortgages for any time between that time, go ahead and look into it. You can talk to your bank, or you can do a Google search for forbearance under the, I forgot what the full name of this thing is, the CARES Act. Yeah, just do mortgage forbearance under the CARES Act. Let's see here. Okay, last thing I want to touch upon is how the COVID-19 is affecting the European Union and its potential collapse. Now, this is something that when we had our roundtable, my prediction for 2020 is that we were going to see the end of the European Union, or at least the process in place. According to a couple of articles here, the European Union is beginning to unravel because of their reactions to the coronavirus. Faced with an existential threat, EU member states, far from joining together to confront the pandemic as a unified bloc, instinctively are returning to pursuing national interests. After years of criticizing President Trump for pushing an America First policy, European leaders are reverting to the very same nationalism they have publicly claimed to despise. Ever since the threat posed by coronavirus came into focus, Europeans have displayed precious little of the high-minded multilateral solidarity that for decades has been sold to the rest of the world as a bedrock of European unity. The EU's unique brand of soft power, said to be a model for post-national world order, has been shown to be empty fiction. In recent weeks, EU member states have closed their borders, banned exports of critical supplies, withheld humanitarian aid. The European Central Bank, the guarantor of European single currency, has treated with unparalleled disdain the Eurozone's third largest economy, which is Italy, in its singular hour of need. The member states worst affected by the pandemic, those of Italy and Spain, have been left by the other members to fend for themselves. Now, this is what Italy is doing since it can't get help from its own European Union. The EU's betrayal of Italy may be its undoing. The COVID-19 pandemic has taken a greater toll on Italy than any other nation. The nations are facing their most severe crisis since the Second World War, with Lombardy in the industrial north particularly hard hit. Yet for all its rhetoric about global citizenship and solidarity, the EU has all but abandoned them. That's even though communist China, arguably globalization's greatest and shrewdest state beneficiary, is ready to fill the void. Coronavirus first appeared in Italy on January 31st when 2 Chinese tourists from the Hubei province tested positive in Rome 8 days later after they landed in Milan. 2 were immediately isolated, quarantined, and the situation seemed under control. That day, Italy confirmed 16 new coronavirus cases, 14 in Lombardy, where it started, and 2 in Veneto. 38-year-old Italian, yada, yada, yada. In just a few days, Italy has the highest number of infections in Europe, with the Lombardy as the pandemic's epicenter. Now, on March 12th, the president of the European Central Bank, Christine Lagarde, marked a point of no return. She gave a highly anticipated speech outlining the measures the bank would introduce to combat the effects of coronavirus. Lagarde decided not to cut interest rates, arguing against the policy of whatever it takes, which had been outlined by the previous ECB president, Mario Draghi. To Italians, the EU's indifference was a betrayal. The consequences of the words were immediate and disastrous for Italian stocks. Even the pro-EU president of the Italian Republic, Sergio Mattarella, released a harsh statement against the EU to correct its ways in the common interest of Europe. The EU did change its position, but not until the crisis had spread to France and Germany. And with few viable options, Italy's government is now considering the European Save the State funds against the EU to implement its $500 billion emergency bailout from the European Stability Mechanism, a risky move that may saddle Italy with long-term debt on a scale similar to Greece. So, as opposed to the bailouts you're seeing with low interest and federal backstop through the Fed to businesses, corporations, and individuals, the European Union is, of course, giving out loans, but with IMF style. that means that they are high interest, and the expectation is that they're going to have to bring in austerity, which has been going on in Southern Europe now for the past 10 years. So, what is... Hold on.
Cough button.
Cough button.
For you this time.
Yeah. So, what is happening? Well, China has geopolitically and geostrategically stepped in, and they are more than willing to help Italy. And what's going to happen in the end is, when all this is said and done, Italy will prove itself to be the first ones, I believe, that are going to say, you know what, the EU is an absolute waste. We're out of here. But it's going to require a political revolution, because while Matteo Salvini, the man of the people, was able to be the vice prime minister before he left office late last year, the the presidency in that are still pro-EU and pro-globalist. So they're going to have to get kicked out. And the more that Italy is under these auspicious quarantines and such, the very essence of political uprising is going to kick them out, bring Salvini back into it, and Salvini is going to take the steps to rid Italy of the EU virus, for better lack of terms, once and for all.
Excellent breakdown, Ken.
Thank you.
Yeah, so very interesting. A lot to look through and chew on. I think it was great to review the CARES bill in terms of how that applies to individuals and business. And as you mentioned, yes, Wednesday we will be having an exclusive interview here on the Gadfly multi-channel network with the prolific writer that you can find at Of Two Minds, and that is Charles Hugh Smith. And want to thank all of our Gadfly subscribers. Please comment directly on this video or in the forums, and we'll make sure to post the details of that interview just as quickly as possible. Ken, thank you so much for a great market recap.
Thanks, CJ, and thanks everybody for stopping by. And it's going to be a fascinating week.